On the markets. Now let's get to Wong Wei, General Manager at Online Unit Trust Distributor, Fundsupermart, Malaysia. All right, Wei, taking a look at the sea of red out there, I want to focus more closely on Japan because taking a look at the opportunities or challenges there, we have some data out today saying the November final factory output came in a little bit better than expected, but still in negative territory. What does this imply for the corporates there?
I think for the corporates, we're looking at a lot of positive developments, not necessarily on the production numbers. I guess, with Chinese yuan depreciating, you see some pressure on exports numbers as well as their manufacturing numbers. But on the corporates as a whole, there's a good news coming out is that, corporate tax will be reduced, and there is plan to reduce it significantly over the next few years to even below 30%. So that's really one good thing that is supporting the Japanese corporates out there.
And the Bank of Japan governor saying today that policymakers will monitor risks and make necessary adjustments. What could those be?
I think really is just trying to look at what is happening in the Japanese economy as well as the broader global economy as a whole. If there is a need, I guess that could also mean some tweaking on their quantitative easing measures. For now, they have not really been increasing the quantitative easing. What they did was to tweak the quantitative easing by a little bit. So last year, they already started to inject, buy different kind of assets, which includes the Japanese ETF, and that has been supportive for the Japanese equities market.
And Wei, you've noted that Japanese corporates are sitting on a lot of cash, which leaves room for dividends. So what are you seeing as opportunities?
I think for the companies broadly as a whole, the whole index, we're seeing that they are sitting on record amount of cash. So I guess there's some pressure for them to change the corporate governance in a way that they give out more dividends, do more share buybacks. And in fact, the dividends rate has been going up 1.9%, although it is low compared to the Malaysia, etc. But if you look at it compared to a 10-year treasury yields, Japanese government bonds over there, it was only at 0.2. So that's a significant thing. And I think they are under pressure to give out more dividends. Main thing also because there's a change in corporate governance, which means that they have to reduce cross-shareholdings. So that is one positive development. I think combined with the giving out of more dividends, that will bring the ROEs closer to maybe 15%. The developed markets are trading at 15% ROE, right? But Japan, the ROE is only at 9%.
So which sectors are you liking?
For us, we like sectors that is still going to benefit from tourism industry, right? That is one place we are looking at. We are also like sectors that is going to be in consumer staples and retail. The main thing for consumer staples as well as retail is that on the employment front, we see that wage growth is starting to turn out. And in fact, if we look at the jobs openings to applicants ratio, it is at the highest level since 1992. So which means there will be further wage growth and consumers are going to benefit from it.
Now let's focus on China, given that it is extending its bear market losses. You're more focused on the H share market.
We are, because I think for investors in Malaysia, foreign investors in general, we have more access towards the H shares. But whatever is happening in the H shares market, of course, suffers from collateral damage of what is happening in the H shares. So at the start of the year, we will note that there were some developments in the equities market in the H shares that caused this rout in the H shares. Of course, one thing would be in China, they started this circuit breaker. So this circuit breaker, I think when it was done, we have this 5% drop, you have a 30 minutes break.
So Wei, are you seeing this as a time to duck and cover then when it comes to exposure to Chinese equities?
Yes, I think it is a good time for us to pick up the shares because I think for the Chinese government, they have very strong flexibility to respond. So in terms of stronger fiscal stimulus as well as monetary easing. So those are the things that they can do.
And then tomorrow we do have a bunch of data out from China, fourth quarter GDP, retail sales, as well as factory output. Today we had property prices, which saw some improvement. How are you reading those signs?
I think these are the signs that's why we are still quite positive on China's economy. Sure, the GDP numbers, maybe the growth rate has slowed down, but even at 6% growth rate, it is still generating almost 2 Malaysia's economy per year. So those are the numbers that we're looking at. For the housing side, you rightly say is turning up already. And if you look at retail sales, the car sales numbers, all these are positive for the Chinese economy. And of course, I think one thing that investors are disappointed, not so much about the circuit breaker, underlying reason on the economic side could be because during 2009, when China responded after the great financial crisis, right? They responded with a fiscal stimulus to the tune of 11-12% of the GDP. And the planned fiscal stimulus right now is just about 2-3%. So that could be one thing where, when Chinese government decides to respond even more aggressively, we can see a pickup in Chinese shares.
Some of the fundamentals still in place, as you pointed out, given the car sales and whatnot. Thank you so much, Wei Yi, for your time today. That was Wang Wei Yi, General Manager at Fundsupermart Malaysia.